Alrighty, ladies and gentlemen, welcome to US Taxes for Expats. Our tax expert answers your question. I'm America Josh, and I'd like to thank you for joining us this evening. We know that lots of you have tax questions. We know that lots of you are constantly sending in messages to myself and Jason asking, what do I have to do? What are the things that I need to know about tax time as it quickly approaches for 2020, the 2023 year in early 2024? Jason and I have done a few of these now. Every year we jump back on here and we give everyone the chance to ask their questions, send them in. So we really appreciate the dozens and hundreds of questions that we had sent in. We want to make sure that we get to as many of them as we can. We've grouped them into categories that we think work for getting to as many of them as possible. We know that we're not going to answer every single person's very unique question. Some of them are so unique that they are specific to you, and therefore it's not going to make sense for us to spend a lot of time digging right into the details. But what we've done is we've grouped them into some categories that make sense for everyone, and we've tried to answer as many of them as we possibly can. So we've grouped them into a few different categories. We've grouped them into the essential questions, the ones that are just vital to understand when you're filing your taxes in the US as an expat. We've then grouped them into the regular questions that Jason gets all the time. So we're talking about mortgages and assets and FBARs and FinCENs. And then we've got the advanced tax filing strategies, planning for the future, investment portfolios, all of the sort of nitty gritty stuff that gets a little bit more nuanced, a little bit more detailed. So to start though, it is important that we put up a disclaimer because every single time this is very important. So this webinar is intended to provide a basic understanding of how taxes work in the US, and some of these answers may not apply to you. If you want to be sure about your specific tax situation, please contact Jason after this webinar. His details and information will be shared, or seek professional tax advice. So we write that because, again, not everything is relevant to you, but we've tried to do our best to answer as many possible questions as we can. So, Jason, I know I get questions all the time about like what a regular return is. I'm just a normal regular return and mine should be easy, but I want to thank you for joining us and answering all these questions tonight. But what is a regular return for you? What are people who are probably watching tonight coming to you with their questions to Uptrend Advisory?
Yeah, thank you. Thanks, Josh. Thanks for having me firstly. And yeah, I guess a simple return, it's a funny question because simple means something different to you than it would to me, than it would to everyone that's attending. So, a simple situation for someone could be, I've just got a W-2, I've got a 1099, I've got a bank account and a super in Australia. But then someone else could say, I'm simple, but I've got 3 rental properties in Australia. So it just really depends, In terms of our clients, I would say like the vast majority are people that are kind of in the middle where they do have some income streams and assets from Australia that need consideration. In addition to whatever they have going on in the US, we do have some people with extra complexities like proprietary limiteds, trusts, passive foreign investment companies. I don't want to throw out all of the jargon because it can be confusing and too technical. And then we do have the people on a very basic side where it's just that W-2, 1099 and an FBAR, but they want to ensure that they're compliant. So it just really depends.
Yeah, awesome. And on that, we are going to, at the end, we're going to go through some of the errors that people make and how to correct those errors. That's right at the end of the webinar, but we've got all sorts of topics that we're going to be going through. So I'm going to start at the very top because I know that a lot of the people that are registered tonight are first timers. So they're, as you were saying, some of them are really simple sort of processes and they just want to understand exactly what they have to do. So when does a US tax return trigger? When do I have to file? If it's my first time, who are these people?
Yeah, so instead of the Australia June 30 year end date, the US system is based on the calendar year from January through December. So every following year, you need to file for the year that just passed. So the deadline to file is April 15 of this year for the 2023 calendar year that just finished.
Okay. So if I moved partway through 2023, do I have to like file in this? Like, how does that trigger? So how do I know that I have to be filling in those forms? Like, how long do I have to be in the country? Or
yeah, so at minimum, you'll have to file an Australian return, assuming you're outbound from Australia. But on the US side, most often you will have to file a US return, just based on the fact that you probably moved here and started employment if you're on a visa or things like that. There are some situations where you might not have to file, such as if you were a non-resident and then just didn't have any income at all. But again, that might be a confusing term because some people might be hearing non-resident for the first time at the moment.
Yeah, yeah, and we will talk a lot about residency because I know that a lot of you have probably read the word resident, residency, and non-residency, and residency rules, and 183 days, and all this kind of stuff. So we will be covering residency very shortly. Stay tuned. So broadly, so we were just talking about you might have to file in Australia, you might have to file here. What's the deal? I know we hear a lot about the tax treaty. Do I have to, if I file twice, am I paying twice, or how does the treaty work at a sort of 30,000 foot view?
Yeah, so that's a great question. There is a treaty between Australia and the US. So there are some countries the US doesn't have a treaty, so at least we have one with the US. Um,
It's not
and
perfect,
so
but it does something.
yeah, it does something. So the treaty is between the ATO and the IRS. The IRS is the federal taxing authority in the US. And so what that means is if you are a US tax resident, you're taxed on global income. So whatever you have in Australia needs to be considered over here when you're filing. Any tax that you've paid to Australia will be credited to you via something called a foreign tax credit against what the IRS wants to calculate on that same income. So in that sense, you are being shielded from double taxation. There is one caveat to that though, and some
Of course.
states have state income tax, such as New York or California, and every state operates like their own country as to whether they abide by that federal tax treaty or not. So if you're in a state that abides by it, great, you get a credit there as well. But if you're in a state that doesn't abide by it, well, then you will be double taxed because that state will not give you a credit for tax paid to the ATO.
Got it. Okay, so it's not so simple as that. If you the tax treaty just means that you don't sort of pay taxes. It means you get assessed in both different countries, and it's country level only. You get assessed in both countries, and then they compare them, and then sort of something nets out. Is a sort of the real broad way of thinking about it.
Yeah, yeah, you get
Yep.
a credit for what you paid to Australia, and then you just hope you're in a state that also recognizes that credit.
Yep. Got it. So, okay, we were just talking about you might have to file in Australia. Let's do a quick coverage of like who would have to file in Australia. What are the reasons that somebody might have to file in Australia? Whether they're new, you've said sort of if somebody was living in Australia for part of last year, that definitely is the case. But if somebody's been in the US for a little while, what's the deal for them?
So if someone's been in the US for a while and they've ceased Australian tax residency as a result of commencing US tax residency, then there are only certain situations in which they'd need to file. If they had income from Australia, such as rental properties, you still have to file to pay tax to the ATO on that rental property, assuming it's profiting because it's Australian sourced income. If you have HEX or help debt, even as a non-resident, you must still file in Australia so that HEX help repayment calculator tells you how much you need to pay down based on your global income. But otherwise, you don't need to file if none of that is in your criteria. If you just have bank interest or dividends, as long as you've let those institutions know that you're a non-resident, they'll start withholding the mandatory non-resident rates, in which case the ATO is getting what they want and you don't need to file as long as you've told the ATO, hey, I'm a non-resident, I don't need to file anymore.
Got it. Okay. And then once you tell them I'm a non-resident, I don't want to file anymore, that triggers that. And then until you then reactivate it, it sort of just sits by the wayside. And unless you change something about your situation, you can kind of just let that go.
Yeah, exactly.
Got it. Okay, so then back to the US. If I find out, and we'll talk about residency in a sec, but if I find out that I do need to file, how do people file? I know that we've had a few people ask about TurboTax and what exactly I can do myself. What is the deal with filing if you were filing US taxes?
Yeah, so I guess firstly is like your residency because certain softwares don't handle certain situations. So
All right. Actually, let's do that. Let's go residency first. Let's skip to residency and we'll come back to how to file. So, can you explain why would somebody be filing in the US? What is a residency? What triggers things?
okay. So residency is determined by your visa and physical presence in the US. So if you're on a green card, like you won the green card lottery and you just moved to the US, well, you're a US tax resident because that visa or that green card automatically makes you treated in that way. You don't have a choice.
Got
If
it.
you come here on an E3 or an H1B, you are subject to a physical presence test, and that's known as the substantial presence test. So going back to the US calendar year, being Jan through December, what that test means is if you're here over 183 days in the country, you pass that substantial presence test, and therefore you're a US tax resident.
Is it 133 days in a row or just 183 days throughout a year?
Within the year, yeah.
Okay,
So you could have come in January, left in February, came back in June, and then stayed the rest, and then you add up all those days.
got it.
If you're on a visa like an F1 or a J1, you do get a temporary exemption from that physical presence test, which would then make you a non-resident. And why all of this matters is because your filing obligations are completely different in the two different scenarios. So if you're a non-resident, great. It means you're only taxed on US sourced income. Everything from Australia is completely out of scope for disclosure. But if you're a US tax resident, then you are taxed on global income. You must declare worldwide income, assets, and structures, and other things if you have other things. So that's, what a
Yep.
resident versus a non-resident is.
Okay, so really, and the US, this is a very important part, is that the US taxes on global income. It wants to know absolutely everything about you. And I know we've had a few people write in the questions saying, I, earn money in Australian dollars and it gets put in my Australian bank account. Does that still get caught by this net for the IRS?
When you're a US tax resident, absolutely. It doesn't
Okay.
matter where the money's being received. You're meant to disclose everything.
Okay, yeah. So if you've got, you're sole trader in Australia and you're just putting into, like, you need to include everything in the filing to make sure that you're compliant.
Yeah.
Okay. So that is the core part of it, is working out whether you're a tax resident. That is a good place to start when you're thinking about, what do I have to file? So let's say now you are so if you're a green card, you're already a resident. If you're on a visa and you've worked out that you passed the substantial presence test, or, you've ticked off those boxes to become a resident and you now have to file, what is the process for deciding, like, I need to file? What actually happens? What do I do? What is tax day that's coming up?
So if you're a US tax resident and you wanted to try self-filing, assuming you've educated yourself on what you need to disclose, then you could use TurboTax because that only deals in US tax resident returns. What you do want to be mindful of is that you know what you're meant to be filing. And the reason for that is because TurboTax is a data entry module. It will do what you tell it to do. It doesn't have the smarts to say, hey, Josh, where's your rental property from Australia? Why isn't it on the return? Put it on this schedule.
Got it.
So the
So
other,
it won't prompt you. It won't ask, do you have properties? Yes, no. It says, like, you tell me what to fill in. Like, you want to file that extra form, I'll take it. But it doesn't actually prompt you for any of those.
yeah.
Okay.
And then the other issue with something like TurboTax is, and this is for certain people, it doesn't have all of the forms. So if you've got, and that's because those forms are very complex and require interpretation. The software can't do it.
Got it.
Such as, trusts, proprietary limiteds, passive foreign investment companies, just to name a few. So if you have those things, you probably can't use TurboTax because it doesn't have the capability. Another big one that catches a lot of people off guard is TurboTax does not file FBARs. We're going to get into that in a little bit, but I just wanted to flag it does not do that. You'd have to do it outside of that.
No, love it.
And then that's if you're a resident. If you're a non-resident, you can't use TurboTax. You'd have to use the sister program called Sprint Tax. And again, it's a data module. Do what you tell it to do. So if you educate yourself and you think your situation's simple relative to your own understanding, then you can self-file. But if you're not and you're just clicking through a software, chances are you're probably going to do the wrong thing, in which case you want to use a professional.
Yeah. And I think, like, I like to call this out, and you and I have joked about this before, but, like, I like to say it aloud. Like, obviously it is in your interest. Like, people come to you and they pay you to file their taxes. So it's like, we're not hiding like the fact that it's a business and that's what you do. But the point is that there are nuances to it. And I can, like, tell you from self-experience, like, there are things that get missed. There are, like, ways that you sort of go down your list and I try to research everything that I possibly can, and I try to tell everything I can, but you don't talk about the particular thing, the business that you ran at the start of last year that you dissolved. But all these little things that you don't think of are really crucially important. So it is important to have someone that prompts you with the questions, because then Jason can go and fill in the gaps in the right forms later on. Okay, I know some ears pricked up because related to that, you mentioned FBAR. So FBAR is something that everyone hears about. I think it is honestly up there on the Facebook groups as one of the most misunderstood. It gets mentioned a lot because everyone has to do it, and then all the answers misleading because people give incorrect information about exactly what it is, who should have to file it. So, can you tell us first? Let's do this in gaps. What is it broadly? Is it tax?
It's compliance to the division of the government that deals with anti-money laundering. So not even tax related. It just got passed along to the IRS to be responsible for managing the submissions. So an FBAR goes to the FinCEN, which is the Financial Crimes and Enforcements Network. So making sure, Josh isn't secretly Pablo Escobar or anything like that.
And that's my next webinar. right after this one.
And all it is just disclosures. I have this in my superannuation account. This is my member number. This is the address. This is the balance. I've got this in my Commonwealth bank account. That's all it is. There's no tax calculation on it whatsoever. But if you don't do it, then there are issues if you get caught. So that's what an FBAR is.
Okay, so it's who has to file an FBAR? That is the next question.
US tax residents. So non-residents don't deal with it. Non-residents for tax purposes, not non-residents for immigration purposes.
Good thing to discern. Yes, very important. Yeah.
So if you're a US tax resident and your non-US assets, when you add them together, not on an account by account basis, when you add them together, exceed 10,000 US dollars, you must complete an FBAR every single year. So assets include bank accounts, shares, managed funds, super. All of those things are considered in that total.
Okay, and its total, is it calculated at the end of the year, like December 31st? Is that how they you?
So yeah, the rules are a bit funny, but they ask for the highest balance in the calendar year. Obviously, you can get that for some things like bank accounts, but things like super, where the reporting
It sort of goes up and
is
down.
quite limited, you kind of have to use the higher of the June 30 or December 31 value because that's all you get.
Yeah. Okay. It's a pain in the butt, but so filing it is separate from your taxes. So you want to make sure you just throw every single investment, bank account, everything, just list them all, right? That's the key to FBAR.
Yeah, just disclose everything. It's just compliance. That's all it is. It's not tax. And in terms of filing it separately, like if you're self-filing, yes, you'd have to do TurboTax and then FBAR separately. But if you're using an accountant, most accountants can file your FBAR as part of the tax process because it all goes to the same place.
Okay. Got it. Is there anything else I need to ask about FBAR? Is there anything?
The only thing I would say is it's asking about accounts you own individually, accounts that you are a joint account holder on, or accounts that you're a signatory of as well. So all of those things need to be factored in.
Okay. Right. So that, could be a lot of accounts if okay. So make sure you've thought big picture about everything you've possibly got. One really good tip, and I know Jason has one of these if you work with Jason, is he sends out a list, a spreadsheet that lets you keep track over the course of the year with what the values and what accounts you've gotten. So it's worth collecting the information now and making a bit of a spreadsheet of all the accounts that you've got, so that when it comes to tax time at the end of the year and Jason says, what was how many accounts have you got? You don't have to start digging towards the end of the year or in the early new year. You can have that already done.
Yeah, with our clients, we have an annual spreadsheet that most people are used to at this point in time, and it just helps to kind of maintain it and roll it forward.
Awesome. All right. To go back a little step, in terms of things in the US about when we're looking at a regular filing in the US, does the US have sort of a tax-free threshold that Australians might be familiar with?
So there's no tax-free threshold like what you think of in Australia. They have a system over here called a standard deduction that US tax residents are entitled to. So if you're earning less than that standard deduction, then you pay no tax because it's one minus the other. The standard deduction is 13,850 if you're single or married filing separately. If you're filing jointly, then it doubles that number. So if you're less than that, then I guess you're in a tax-free threshold, but it's not the same thing.
Okay, awesome. Um, One of the other things that I know a lot of people asked about from comparing Australia and is superannuation, because I know that there are a lot of questions that come in every year for you around tax time around how super is treated when it comes to taxation in the US. I'll fully say at the start, like you're going to hear answers that Jason gives, and then you're going to hear different people with different professionals that have sort of different varied opinions on exactly the nuances of this. But Jason, what's your professional opinion on how superannuation is treated in the US?
Yeah, so the root cause of why there's such open interpretation is because of the fact that superannuation is not called out explicitly in the tax treaty. And so that's why everyone, has an opinion. So um, just like politics. Um, so in terms of our approach, we typically ask if it's a regular industry super fund like Rest or Host Plus or something like that. And if it is, then we try dig a little bit deeper to understand, okay, well, if it's that kind of fund, what is the composition of the fund? Let's say, Josh, you have a super fund for $100,000. I would ask you, well, what's the composition in terms of your contributions versus your employer's mandatory contributions back when you were working? If it's leaning towards your employer, as in they've put in more than you have, then from our perspective, we would just disclose this through the relevant asset disclosure forms, but we wouldn't really treat the growth as taxable. But let's say it was inversed, as in you contributed more than your employer, well, then that's when we would start perceiving it as something known as a foreign granted trust, where the growth would be taxable year over year based on the tax legislation at hand. Um, if you have another kind of fund like a self-managed super fund, that one's pretty black and white for everyone. It will be treated as a foreign granted trust. You will have to file a trust form every year where the growth would be taxed year over year. So you don't really want a self-managed super fund when you're in the US. And then you will have other firms who, no matter what, are always going to just tax the growth year over year because they're just going to do it because they don't understand it.
Yep.
And then you'll have other firms who make tax treaty positions that you can read up on as well, which carry
Yep.
their own set of risks. So
Yep.
it just depends.
No, it's worth asking the questions. It's worth going through, and understanding exactly why the person that you're speaking to might have answered in a particular way. So make sure, yeah, you do ask the questions. In saying that, I also want to let people know that we've opened up the Q&A, so you can ask your own questions to us and we will answer them. I'll flag them and we can ask them with Jason. We did have one question come in that just is around the idea of if you haven't filed FBARs correctly, we will get at the end, if you're hearing anything around like taxes or FBARs that you're thinking, oh my God, I haven't done that right for years. That's all right. Wait until the end of the webinar because we are going to go through what to do or there are some matters of recourse that you can go through. We were talking about self-managed super funds and things that you've got control over. So in saying that, there's also the idea of assets and property. How should people be declaring, or how should people be thinking about investments and income from Australia on your US returns? So investment properties or investments in stocks or general capital gains or sales of shares and stocks.
Yeah, so that again comes back to the whole tax residency thing. If you're a non-resident, you don't have to worry about it. But if you're a resident, you must disclose everything. So if you've got a rental property portfolio in Australia, you've got to declare it. You're going to be obviously putting everything on a calendar year basis. And then same thing with, dividends, capital gains, any kind of stream of income you have from Australia, it must be considered on your US return. There are different schedules for different things. So it again comes back to what I was talking about with the self-education piece. Like a rental goes on Schedule E, sale of shares goes on Schedule D, dividends goes on Schedule B. So it's one of those ones where it's possible, but you have to know what you're doing, kind of thing.
Yeah. Okay. Good to know. So again, It's nuanced. It gets difficult. Like you have to know exactly which one's which, and that's the same, I imagine, for investment properties versus the house you own, or like any assets, anything you've got. They've got their categories, but they're all going to be different and unique.
Yeah, yeah. The only one that's different there is like if you own your home and it's your primary residence, then that doesn't go on a rental. That goes on a separate schedule where you can possibly benefit from it through claiming some mortgage interest. But that is again if you're a homeowner and you're living in that home.
Okay.
But
What
again,
about
nuance.
people? Yeah. What about people that, like, from a tax perspective, is it something that people should be looking at investing and buying property in the US? Is that something that you sort of strategize with them from a tax perspective?
Yeah, so the real estate tax code over here is far more advantageous than it is in Australia when it comes to deferring capital gains and things like that. Negative gearing is not the same as it is in Australia as it is here. Slightly different rules and restrictions, but it is something. But it's actually something you should maybe chat with a financial planner or advisor about because that's when it's wealth management and preservation strategy as opposed to just tax, where that's just one consideration of many.
Okay, good to know. And we, like America Josh, will be doing lots more of these kinds of webinars where we're talking about those kinds of strategies as well. So it'll be including Jason and tax elements, but also sort of investments and strategies and more broadly thinking about finances. Um, I know that some people have received some accounts from Australia or from the US from the US for W8s and W9s around staying compliant with their banks is one example. And I know that some people may have received them from a few different sources. Can you explain what a W8 or a W8 Ben or a W9, what these forms are exactly?
Yeah, so all it is a withholding form that banks and institutions require you to complete. So that way they know if they need to withhold tax from you or not. So a W8 form is what you would give them if you're a non-resident. And then that way they know, okay, this person's a non-resident. So we're going to withhold, 30% on their dividends. Whereas a W9 is what you give them when you are a US tax resident. So they know you're going to be filing anyway, and therefore they don't need to withhold any tax from whatever they're paying you.
Got it. So it's like having a discussion with the bank formally. You're not filing it. You're just giving them it's a questionnaire. They're asking, here are our 10 questions, and you're responding with your information so that they know exactly
Yeah.
how to respond. Okay. We've had a whole bunch of questions come in, so I want to touch on a few of these before we move on to the sort of more advanced stuff around the minimizations and deductions and things and the fixing problems. Just, do you want to recap how the double taxation policies or the tax treaty, we were talking about how some states do and do not comply. Can you just clarify how that works? So if let's say I'm living in, well, I don't have to, let's say I'm living in New York and my state does not take part, or it has state tax and city tax if you're in New York City. How does that fit into how the tax treaty works? Do you just want to break that down?
Yeah. So at the federal level, you're going to get a credit for the tax paid to the ATO on that income, but at the New York state and city level, you will not. All of that income, let's say, Josh, you're 100 grand of income and your rental gave you 10 grand profit. For New York tax purposes, you're taxed on 110 grand. It's that
Okay.
simple.
Yep.
Yeah.
Right. Oh, cool. Okay. Well,
Yeah.
there goes my investments.
Yeah.
Speaking of paying tax, so how can someone, like, if someone's watching and they're like, I know we've got a few questions around like planning a trip into the US or people that might have been living in the US. Is there a way to sort of just think more generally about like how they can save money on the taxes doing a regular, is it W2s? What's the deal with 1099s? We've had a few questions come in around like, is that a way to fix things? I know this isn't a legal, like this isn't about immigration, but can you just explain from a tax side and accounting side how that works?
Yeah, so the W2 is the group certificate equivalent over here. It's what shows it shows what your employer has paid you for the calendar year that just passed. The only way to reduce taxes on that element is pre-tax deductions using something like a 401k contribution where you're deferring tax on whatever you're putting into that fund until you withdraw from that fund in the future, or using HSA health savings accounts where you can pay for medical expenses with pre-tax dollars because medical system over here isn't cheap. Um, so, but otherwise, unfortunately, when you're an employee over here, you don't get that many deductions that you can claim annually. So all of the work from home expenses and things like that that you could claim in Australia, they don't apply over here. The tax code favors those that are self-employed because that's when you can expense a whole bunch of things against your income. But if you're a regular W-2 employee, you're really limited to those two things. And then outside of that is just going to be lifestyle things that, may or may not apply, such as having kids and getting child tax credits annually, or owning your home and itemizing what I was talking about earlier, or if you bought an electric car this year, you get a credit. But there's no kind of strategy you can use just against that W-2.
Okay. So really, yeah, we are treated in that sense like sort of any American who is on an income, like we are. You can sort of do your Googling about like what to do for a normal W-2 employee. You are sort of just a W-2 is a normal employee in the US, right?
Yeah, just a
Yep.
normal employee. They might have some 1099s, and 1099s could mean a lot of different things, but yeah.
Yep, cool. Is there, in terms of strategizing, in terms of minimizing, so well, we might not be able to do something if we've already got the job. In terms of timing around when you might want to move to the US, or we'll start with moving to the US. So should people be thinking about, obviously the calendar year is how the US, so the US does it January through December is a
Mm.
tax year, whereas Australia does July through June. Is there any way to think about like what might be smart if if I'm projecting out and I want to potentially move to the US, what should I be thinking about? What should I be planning? What kind of timelines should I be adhering to?
Yeah, so it's a multi-pronged thing, but I guess the first thing is if you have things that are going to be negative in Australia from a US tax perspective, you might want to plan to move later in the year in the US. That way, depending on your visa, you can be a non-resident for that calendar year. And the reason for that is because when you're a non-resident, you don't disclose what you have in Australia. So it gives you an opportunity to clean stuff up before becoming a US tax resident.
Okay.
So just an example, you've got a trust in Australia that you're not using. When you're a US tax resident, you have to file a trust form. If you don't want to pay someone to do that trust form and deal with the consequences of that, wind up the trust and then move later in the year so that you're a non-resident and don't even need to disclose any kind of trust that existed on your US tax return. Obviously, that's visa dependent, but that's just one example of why timing things might make sense. Or another one is I'm about to sell my primary residence. Uh, I'm selling it this year. Okay, I don't want to have to declare that to the IRS. So I'm going to move later in the year. So I'm a non-resident and therefore that's not in scope. So it's all of
Right.
those kind of it's
Yeah,
person
yep.
by person kind of things.
Yeah, and that's where it does really get nitty gritty about like exactly what your situation is. It's not sort of like everybody should move July 2 because July 2 is the best day to move. It's yeah, what you can wind up, what you can. So, in terms of the credits, like what we were talking about before, and in terms of planning these kinds of moves and working out tax years, what like how does the credit work? Is it like you bank it and it sits there waiting for you to use that credit? Like how does the overlap work with the idea that the tax years run in a like different half of the year?
Yeah, so it comes down to methodologies of how you deal with the foreign tax credits. There are some accountants who will go payslip by payslip by payslip and work out dollar for dollar what was actually paid, but then you're limited because then there's a gap in time for a return which won't be prepared for another year because of the differing things. Or you'll have other accountants who look at what your effective tax rate is going to be based on your Australian income and then apply that to the calendar year income to get a best approximation. So it just depends on what the methodology is. But let's say you have a situation where Australia is taxing higher than what the IRS wants to calculate. Well, the amount that's in excess of that, you get to carry that forward to future years and can use that in future years against more foreign income. And eventually you just keep growing that bucket. And hopefully that helps you in a situation where the IRS is calculating tax on something that the ATO isn't, and then you've got this credit to offset against that.
Got it. Okay. Cool. Love it. I'd love to like it. Okay. I'm trying to think of a cool like there's so many different things you could wind into and work out like how you could strategize, but this is exactly the point of like why you
Yeah,
could
it's technical.
yeah,
Yeah.
it's technical and like that's why you need to talk someone through. You need to be able to sit down and open up your books and be like, here's my story. What do I need to think about? Like, it is something about strategizing. We had a question, and what I wanted to talk about sort of line up nicely around green cards. So if I'm entering the lottery, or if my employer is potentially looking at a green card, we were talking about residency at the top, and we were talking about how a green card implies residency. It is a permanent resident of the US. How does it work with timing in the US, and how that works if you're on a green card? Or is it just that you've got the green card no matter where you are, you're now a resident of the US and that's it?
Yeah, as soon as you get that green card, you're treated just like a US citizen. And so what that means is you're always going to be a US tax resident no matter where you are living in the world. So that's
Okay.
essentially the handcuff situation.
Yeah. So that is okay. In and of itself, it is very important to think about if you're going for a green card. It's not a like, cool, I want it and I could use it for a few years and not necessarily be in the US for the whole time. If you can do that, but like you're going to have to pay taxes to the US for that entire time.
Sorry,
Um,
can you say that one again? I
oh,
was
no,
just
sorry.
reading the
No, no,
questions.
that's right. So so in terms of the green card, okay, so if you have the green card and then you leave the US, what are the things that people need to worry about there?
Right. Yeah. So there are immigration things that you would need to consider, which you and I can't talk about, like physical presence to maintain and stuff like that. But
Yes. Yep.
from a tax perspective, it just means that when you've left, you're still bound. So you still have to file the exact same way as if you were filing over here. So whatever you're doing in Australia still needs to be declared every single year. Um, a big thing is uh, exit tax. So if you get a green card, you have this burning platform where you need to make a decision as to are you going to become a US citizen or extend your green card before possibly having an exit tax, as opposed to if you gave it up before that was a real thing, then you avoid that kind of issue. So I think, Josh, we have an article on this, but it's the Heart Act, which is a bit heartless, but it is what
It's
it's
one of those.
called.
It's one of those beautiful US legislation names that uses an acronym that is like the opposite of what it means. But
Yeah.
yeah, so the Hard Act, yeah, is definitely one to look at if you are thinking about applying for a green card and knowing that is it 7 years of being on a green card or
So it's
thereabouts?
eight calendar years,
Got
but
it.
sneaky nuances. It could be 6 calendar years and 2 days. And what I mean by that is, let's say
Oh,
you got your green card December 31, 2023. Even though it's one day, that's counted as 1 year towards that 8 year test.
wow, that is brutal. Okay, 6 years and 2 days. All right. And if you aren't in the US, how do they assess like which do you reside in a particular state in the US? If you're not actually living in the US, how does that do you have a location?
No, there's American citizens living in Australia. Their address is
Yep.
Australia. They don't have any ties to any particular states unless they've got that California rental property, in which case they're just filing a California return and only declaring that California rental on that return.
Got it. Okay, so you're only looking at the federal taxes. If you're a green card person and you're not in the US for a particular period of time, putting aside all the legal issues, which by the way there are a bunch of legal issues, but putting those aside, you're just a federal floating member of society. Um, okay, Jason, the 401ks, where we're getting into like people are planning on living in the US and they get offered by their employer, a 401k. What is the like? Let's start with: should I invest in my 401k? This, and we're not talking about the like, is there a financial growth benefit to it? But from a tax perspective, is there an implication if I want to move back to Australia at some point? What's the deal with investing in a 401k?
Yeah, so from a US perspective, it's great because it allows you to reduce your current year's taxable income by however much you're deferring to the future. But then it does become a kicking the can down the road scenario whereby that funds will grow, hopefully grow over time. And then when you withdraw from it, firstly, when you withdraw from it in the US, because it's tax deferred, however much you're taking out will be taxed at your marginal income rates. So that's first one. Two, if you take it out before you're 59 and a half years of age, you will have to pay a 10% early withdrawal penalty on top. The Australia situation comes in where, let's say you've moved back to Australia, you've triggered Australian tax residency, you're then taxed on global income, which means if you withdraw from your 401k, the ATO is going to tax it. And they've already come out with private rulings saying we do tax 401k. So they will give a credit for tax paid to the IRS because of the tax treaty, thankfully. But it is something that should be considered. So, if you're getting a match, if you're here for several years, it might be worth it if you factor out all of the outgoings, the 10% penalty, the tax, and everything like that. And it might be worth thinking about the timing of when you take it out. Do you take it out before moving to Australia? Do you stagger it over a number of years to reduce the tax? Do you wait until retirement to avoid the 10%? It's case by case.
Yep. Okay. But another thing, so yeah, there is definitely, it's not a no, don't worry about 401k, it's too complicated. It's not everyone should take it, but there is money on the table to be at least worth having the question, because if an employer is willing to match, that means, and for those of you who might not be as familiar with it, that is a big thing that will be part of offers when you go for a job. There'll be 401k matches, so whatever you are willing to contribute, the company will match that amount up to a certain value. That is effectively free money in one way, shape, or form. It comes with strings and all sorts of caveats and things that you have to talk to Jason about, but there is definitely something in there, and you should look into it because you do not want to just miss out, and you can actually minimize your tax at the same time. So yes, lots to think about for 401ks. If I don't know, I guess it doesn't really change anything. It doesn't matter whether you're going to stay in the US or go back to Australia. It really just comes down to working out the plan for the next 50 years of your life. Is that right?
Yeah, yeah. It's just long-term planning and thinking about what the best way is to retrieve all of these kinds of income streams in the way that's most tax efficient based on your lifestyle needs. And then that again kind of leads into there's a lot more than tax to think through here, and it might be better to chat to a financial planner who can again look at the broad brush at every kind of thing that needs to be considered.
Yep. Okay.
More than
How,
tax. Yeah.
yeah. How does capital gains come into that when you're talking about, like, broadly? Is there some things that we need to know as an expat separately from what a person in Australia might be looking at from capital gains?
Yeah, so the system for capital gains is different over here. In Australia, you've got the capital gains discount where you can get 50% off or 100% off in certain situations. At the federal level, there is long-term or short-term as well, and it's just taxed differently. So if you've held an asset like a share for over a year and then you sell it, you're going to be taxed at long-term capital gains rates, which are lower than, regular marginal tax rates. Could be 0, 15, or 20%, depending on your overall income level, which could be lower than if you're in like the 30 or 40% tax bracket. Short term is if you've held less than a year. And if you've held less than a year, then you're taxed at your marginal tax rate. So it's just treated like regular income. So, a quick win is to not sell when you have short-term gains because you're paying more tax when you could avoid it. And then at the state level, most states don't have a capital gain system. It's just all marginal.
Yeah, right. Okay, cool. And what about inheritance? That's another one that comes up in this sort of similar space of money sort of moving in and out. What's the deal with inheritance if you're living in the US and you potentially inherit something from someone in Australia?
Yeah. So assuming they're not a US person, like the person that gave you the inheritance, and not a US person being not a citizen, not a green card holder, not a US tax resident, just to clarify. If you've received over 100,000 US dollars worth of assets in a year, all you do is disclose it via a special form called a 3520. There is no tax on it whatsoever, but it's a disclosure you've got to complete, just like the FBAR.
Is that the same for? So is that just it for inheritances? Inheritances.
So that form is a multi-use form. It's mainly used for trusts, but
Okay.
there is a section there where it says you are a person that received gifts or bequests or inheritance, and then you just
Okay.
complete that whole
So,
section.
so gifts is like if you can receive gifts. What about a gift from a family member or a gift from a family member is a good example. If it's over that, so if it's under $100,000, is that right, for a calendar year?
Yeah,
You just receive it and it can be happily received and you're okay. If it's
yeah,
over that, you are permitted to do it. It's not taxed any differently. It's still a gift, but it just has to be reported that I got this money, and that's kind of like the FBAR, FinCEN, just making
yeah,
sure that money's not
exactly.
flowing
You're
around the
not
world.
taxed on the gift that you've received at all or the inheritance. It's just a disclosure exercise.
Okay, got it. All right, that moves us into now that I've brought up FBAR and FinCEN again, and taxes and misfilings and errors. So, what I'd love to know now is there's probably, and I've been teasing this for the whole time, dealing with mistakes. What is the deal if I've filed? So let's start with, and because I know they're a little bit different, FBAR. If I haven't filed an FBAR, or if I've filed it wrong, what do I have to know? What do I have to do right away?
Yeah, so the important thing here is to kind of quantify what all of the gaps are. Because if it's just the F bar, okay, then here's Avenue 1. But if it's an F bar and a missing Form 8938 and a missing rental property and this, then it's a different kind of recommendation. So in the sense that it's just an F bar, everything else is above board and completely declared, then firstly, if you filed the FBAR originally and you're just adding a missing account, you can amend an FBAR. That's not an issue whatsoever.
Okay.
If you haven't ever filed an FBAR and everything else was declared, then there is a procedure called the delinquent FBAR procedure that will allow you to get back into compliance because
They
it
make you feel
happens
really
so
good about it, don't
often.
they? It's like,
Yeah, it
yeah,
happens often enough. They made a procedure for it. Uh,
yeah,
but if there's a combination of missing FBARs, missing foreign forms, missing foreign income, then depending on the why, as in why these things weren't done, you could possibly go through one of the IRS amnesty programs to get back into compliance. Um, if you knew you had to do these things and chose not to disclose them, well, then your options are a bit more restrictive and punitive because you knew you had to file and didn't.
yep. Okay, so the word, is there a, like, if you get caught and you weren't doing it, that's real bad. If there's the, you knew you should have filed it and you didn't, that's just as bad. And then there's the, down the bottom is the, you just actually, like, oblivious and you didn't file it
Genuinely,
and
yeah.
you may genuinely made a mistake. There are ways that you can effectively, what is the sort of, broadly, you sort of write a letter and say, like, I stuffed up, and is that when you sort of would, I imagine you'd immediately approach someone like yourself before you write to the IRS yourself?
Yeah, yeah. Like if you're in that boat, you definitely want a professional, whether it's me or someone else, to help you with that. But you would want to go through a formal program, a remediation program with the IRS, whereby you're amending the returns to include what should have been included originally, pay any back taxes that were owing, because had you declared the things originally, you would have owed those things originally.
Yep.
And then you will have to most commonly include a certification statement, explaining all of the good things and
Like,
bad things as to why
please,
you're going
sir,
through the
like,
program to demonstrate, that you are non-willful and that
yep.
you're making a good faith effort to get back into compliance.
Okay. So yeah, there are, like, that is I know we had a bunch of Q&As pop up when we were talking about FBARs before. There are ways to get around it. Do not freak out. And the worst thing you can do, well, and Jason, you can confirm this. The worst thing you can do is sort of now close your eyes and close your ears and say, like, it'll go away. The best thing you can do is go speak to someone, or like actually get ahead of it, because you don't want to be caught out, because that looks especially bad, right?
Yeah, I mean, like the reasons why getting caught would be bad is because, unlike Australia, the IRS has some ridiculous penalties they can levy for not completing simple disclosure forms.
Okay,
Uh,
right.
yeah.
Yeah, no, it comes down to money. Like, they will fine you, and it will be potentially bad. So don't ignore it. Don't put your head in the sand. Speaking of, what are some of the, like, as we sort of get, and we're going to go back to a few of the questions at the end, but what are some of the things that you see people do incorrectly? Like, what are the most common mistakes that people who come to you? What are the most common mistakes that you see?
Yeah, the most common mistakes I see are really from, there's different kinds of situations, but like someone that's gone to just a regular US accountant and the person doesn't know international tax, they don't ask the Australian about what they have abroad. So it leads to a situation where nothing's declared because they didn't know that they had these things and the client didn't know because they didn't know the US tax system. Um, or people self-filing through TurboTax where again they think it's going to prompt them about these things but it doesn't, and so that ends up
And
creating
that will say at the end, like, you've successfully filed. It doesn't say,
yeah,
like, oops.
yeah, and you feel great, you think you're done until you learn about these rules.
Yep.
And then the other one is, you know uh, when you self-file not claiming deductions you could have claimed, making typos in names, missing social security numbers, declaring things in a wrong section, or things like that, that could actually lead to you possibly paying more tax than you should have. So it's, those kinds of mistakes as well, beyond just compliance mistakes.
Yep. Okay. And how does it work for you? Do you require that people be in the US if they want to work with you, or like what is your process? If somebody wants to say like we've had a few questions of like how do I get in touch because I've got some further questions. What is the process if they want to get involved and speak to you about their taxes or filing, or do you offer like classes or yeah? What's the next step if people want to get involved?
Yeah. So in terms of, our services, we prepare US tax returns. We don't prepare Australian returns. If that was a need of yours, we do have a firm we work with that we can refer you to. And then separate to that, we do provide Australian US tax advice. But that service is exclusive for clients who file through our firm, just because, there's limited capacity.
Yeah.
And in terms of how we quote and everything, we quote based on the forms that you're required to submit. So someone that's got multiple rental properties compared to someone that doesn't, is there's going to be a delta in price.
Yeah.
um, and then yeah, most people just reach out through our website, they book in that 10-minute discovery call, we talk through their requirements, and then we provide them a quote, and if they'd like to proceed, then it's just a uh, off to the races from there.
Cool.
So it's
Yep.
it's fully remote. Yeah.
Okay, cool. So yeah, they don't. It doesn't matter where you are. I've got a question right now about do you have a list of taxation agents for US in Sydney? So you are based. Where are you based? Just you're in
Yeah,
West
I'm
Coast of
in San
US.
Diego, California.
Yep, there
Yeah.
you go, San Diego, California.
Um,
So yeah,
and
it doesn't matter where you are. If you're in Australia or if you've moved back or if you're planning to move and you want to file with you like this year, that's something yeah that you can sort of set up and you have that 10-minute onboarding to find out what kind of documents you might need to file, and then that's how you quote. Is that right?
yeah. And then once we're able to quote and the client would like to proceed, then we'll send through everything that we would need. And then it's kind of starts the full engagement. And in terms of our clients, we've got clients all over the US. We do have clients in Australia. We do have some clients in other countries as well. So we can pretty much service everyone.
Yeah, cool. So I know that it's like I've just put up this QR code and the QR code goes to the same address, uptrendadvisory.com/Josh. That is a page that Jason's put together, which is just a whole bunch of expat tax related information broken down for particular visas, broken down for green cards. It's all the FAQs. It's a bunch of the stuff that we covered today, but it's also a whole bunch of other questions that are a little bit more detailed. And in some cases, they get into a few more specifics about the exact nuances of questions. So if you do have some of those questions, make sure you jump over to that website. We're going to go through a couple of the questions before we finish up. I know some of the questions that have come in are around, again, just working out this residency idea. And if you've worked remotely while you were so this one's, I worked as a contractor for an Australian company. I 100% remotely from the US, but they paid into my US bank account. So does that again come down to just where your residency is based? Is that sort of the crucial part of the question?
So that one could be a bit complicated in the sense of, are you working through an ABN or are you working through your social security number? If you're working through an ABN, then it could be considered Australian sourced income because you're doing it through an ABN. But ultimately, if you're in the US and working in the US for an Australian company remotely, it's most likely actually going to be considered US sourced income because that's where you're earning the income. But then it can get a bit complicated with regulatory requirements and how that Australian company may not be actually able to have you as an employee overseas.
Okay, cool. We've got another one around tax credits, just around exactly how that works when how the credit is applied. So let's say I earn 100K in the US and 100K in Australia. I pay 30K in tax in the US, sorry, in Australia. I pay $30,000 tax in Australia. Then will that 30,000 deduct from my worldwide income to get my total income to calculate the US tax, or is it deducted? Like, what's the sort of, how does that credit work? Is it based on what the assessment is in the US and then you subtract that, or is it off your income?
Yeah, so at a very high level, it's probably makes sense to just run top down. So how US tax calculated is what's your worldwide income, so Australian plus US. What are the basic deductions you'd claim? And then That is your net taxable income. How does that land in the marginal tax table? And that shows tax calculated. And then it's at that stage where you back out the foreign tax credits for tax paid to Australia on the component of that tax that is charged on the foreign side. So it's at that stage that it's taken out. And then you end up with, well, what's your net refund or bill after applying
Got it.
your withholding? So an important thing that some people might have picked up there is that while your Australian income is shielded from double taxation, your US income is actually pushed into a higher tax bracket by combination with that income.
Okay. Yeah. And it's a very important thing to factor into your, yeah, when you're calculating exactly what you've got going on. I want to flag, because I know that some people do have to jump off and I'm aware of the time. We'll go through a couple more of the questions, but I wanted to let everyone know that we are going to send you a feedback form. And the feedback form also includes a way to get in touch with Jason if you do have some follow-up questions. If you do want to start one of his 10-minute consulting calls to take him on and have him do your taxes for the 2023-2024 year, that is all found in that feedback form, and Jason can get in touch. And it's also got the links. If you go to uptrendadvisory.com/Josh, at the bottom of that page, you'll also find the form that lets you fill that in, and you can get in touch with Jason directly. So Jason, we'll go through a couple more of the questions after this, but I want to thank you very much just while we've got everyone on board for the time. I know it's an hour out of your evening to answer a lot of the questions, and we sincerely appreciate it. So thank you, mate.
Yeah, it's my pleasure. Anytime.
Love it. We'll go through two more of these questions. So there's one around married. We didn't talk about married filing jointly. Can you just explain how that works in the US, and is it the same as Australia? Like how does filing as a married couple work
Yeah.
in the US?
Yeah, so this is a system, honestly, it would be great if Australia did it, but it allows a married couple to file one combined tax return where both spouses' income streams and assets are considered on the one return. And that, for most people, ends up being tax advantageous because one, the married filing jointly tax brackets are actually better than the single or married filing separately tax brackets, like that marginal tax table. And then two, if there's a discrepancy between the income levels, like let's say one is 200 and one is 50, well, then the 200 is going to benefit by filing jointly because they're going to drop tax brackets by combination with the lower income earner. So that's kind of how it would work. People that tend to file separately are those that manage their relationship like separately, like all
Separately.
their
Yeah.
other finances separately. So it's just kind of an extension of that line in the sand. Or if someone has a simple situation and someone has a complex situation, the simple filer wants to keep it simple, and so we'll just file separately.
Okay. Yep. So it is a possibility you can do it. Obviously, again, putting aside the legal and the immigration side of things, but from a tax perspective, you can choose what would be best, and that's again something that you can discuss with them. And the last one I think I just wanted to touch on was around there's one around green cards again, which is just this idea of like can you be, sorry, that's what I was going to ask. Can you be a tax resident? So if you're on a green card and you're in Australia and you're present in Australia, does that mean you can be a dual tax, like you can have tax presence in two different
Yeah,
countries? Yep.
absolutely. A classic example of this is American citizens living in Australia.
Yep.
They're going to be Australian tax residents because they're living and working there, and they're going to be US tax residents because of their passports. So that then creates a situation of everything's going to be disclosed to both countries, and then the tax treaty comes into play where Australia is going to tax Australian income first, the US is going to tax US income first, and then the other countries take the tax credits.
Yep, got it. Jason Stock from Uptrend Advisory, mate. Thank you very much. Everyone should go to your website, read all the FAQs, read all the questions, fill in the form at the bottom, have a chat with Jason. He will do your taxes. It's getting busy for Jason. We're headed into tax season, or we're already well and truly into it. So Jason, yeah, look behind you, Josh. But thank you, mate. We really appreciate you taking the time, and thank you everyone for watching tonight. We've had good fun going through taxes, and we'll be in touch with the feedback form and look forward to hearing from you. Thank you.
Thank you.